Well, I think we got the go ahead to start. Okay. So thank you all for joining in. Today's topic is very interesting. Today's topic is about public sector funds. And this is a topic that is very dear to us because I have to give you a disclaimer that we do have it in our PMS, and also we've had very high significant positions on during our RI service, and it was a part of Milestones to Wealth before it actually became Milestones to Wealth. So this is a topic that has gotten a lot of traction in the last 1 year, but we have been tracking the space for a very long period of time. So hopefully there might be some data that I might give you, which is good for you to look at, because now things have come to light. Now a lot of and all of this is public data. None of this is data that we had to calculate on our own. Now that everything is coming to light, so a lot of data is starting to come out. So you as investors now have that ability to understand how these cycles are playing out and how you can take advantage of these cycles. Right. First, every time I start off with my webinars always with one particular slide. It's either this one or the quilt. So you look at this slide always. You always have to look at markets from a cycle perspective, and that whenever there is extreme optimism, you will see a lot of buys that come in. But when there is extreme pessimism, you will see a lot of sells come in. So you as an investor need to be contra, which is more buy when there is fear and sell when there is greed. Now, this doesn't happen in a year. This doesn't happen in 6 months or 3 months or 4 months. This happens sometimes over 5 years, sometimes over decades. Now, the theme that I'm trying to talk to you about has taken a decade, right? Has taken a decade for it to play out completely, and significant amount of changes, significant work that has happened in this entire space from 2014, 2015 onwards, right? So almost a decade is where you see market cycles starting to play out. Right. So always understand that things are cyclical, and things that are very sensitive to cycles are core to economy, and public sector happens to be one of the core parts of the economy. They happen to be monopoly businesses that operate in these core sectors that are the core sort of drivers in growth, in GDP growth, right? So they are very sensitive. Any bad macro year, naturally everything will get affected. So today we are not in a bad macro year. India is very strong compared to all the other countries. We don't have very high inflation. Our inflation is now being controlled. Our interest rates, there is no sort of uh, talks of cut, but market is expecting some cut globally also to take place. But given that global inflation is very high, there's no cut. So India happens to be good, the rest of the world not so great, right? So in this scenario, naturally things that are very sensitive to economic growth will give you that sort of higher alpha. And this is what has happened in the last 3 years, where economic sensitive sectors have gotten a push. They have gotten support from the entire government, and that has now not become sensitive. That is becoming stable. That is not sensitive anymore. It's not turning out to be cyclical because the government is supporting them in a very big way, right? So let's look at how the entire cycle has played out for public sectors first. Now, why PSUs now? Right? That's one question that you should ask, right? So PSU, and all of this is public data. So PSUs are there in almost every sector because, like right, everything was government owned, and then we were allowed the space for private companies to come in. But by virtue of that, public sector companies are there in every sector that's there. Right? You can call this as one way to make sure that the pricing scenario remains where the government takes majority of the decisions. Uh, yeah, basically the control doesn't go from uh, uh, public to private, right? The entire reason of this is that private should not be able to take undue advantage of pricing, where somebody can undercut somebody, where here the government maintains the pricing scenario, maintains competitiveness, maintains everything by being in that particular industry. So you know that they are there in the energy space, they are there in the oil space, they're there in the metal space. You know that they're there on logistics. Now you're seeing dedicated freight corridor come in. They're there in the port space as well. You know that they're already there. Again, metals, energy. is the same. They are also there on agriculture, right? They are there on the textile space. They are there in financial services. You have banks, you have insurance companies. Defense is now one of the major contributors to public sector as an entire industry doing as an entire theme doing extremely well. Then there is power. You have NTPC, you have Power Grid. These are companies that lay the groundwork for everybody to sort of grow, right? For private entities to grow. So what the public sector companies do is they first try to go and lay that groundwork, spend money, and then give that uh, direction, give that sort of place for private entities to come in and start pumping in that money, so that the entire cycle of growth keeps on going. They're there in telecom, they're there in fertilizers, they're everywhere, right? PSUs are everywhere, and that's how you're able to get these wide investment opportunities on the public sector space, right? But public sectors have not had a positive sentiment over the last 10 years. Things were extremely negative. How is it that now suddenly people are saying, no, 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 this is extremely important for us, right? Now you look at this. This is the most important slide for us. Now, uh, FY15 to FY20, you see that the growth in net income was negative, right? You see financials doing extremely poor, right? The public sector banks doing extremely poor in that entire 5 years, right? Again, you see non-financial, that is our entire energy, metal, and everything else. You're seeing the profit pool of these uh, companies starting to go down, right? Naturally, when the profit pool starts to go down, your price, if it remains high, so it looks very high, right? It looks like it's high PE, right? Because it's high PE, what happens? Either it stays there or it comes off, right? It either reverses to mean, or because by virtue of no growth, there's no incremental sort of growth that you can get just by investing in those names, right? Investing in those particular themes. But what was a deep concern that happened was that profit pools started to go off, and naturally market was taking cognizance of that, and share prices started to come up, right? That was one way that showed that yes, things are extremely negative on the public sector side. Now, knowing well that yes, there has been a increase in sort of profit pools because by virtue of low base and things changing, they've gotten recapitalized. A lot of pricing improvement has happened. Commodity prices have gone up. Operating leverage has started to kick in. Uh, so what do you think is the performance? What do you think is the performance of those public sector funds in the entire of last year? So it's a poll. Please put your answer in the comment box, chat bot, chat box. Okay. So we have three Ds and one C, and Ds are 45 to 55%. Okay, C is 35 to 45. 35 to 45, don't you think is a very low hanging fruit compared given last year? Okay. Okay, so the right answer is more than D. Actually, it is more than 55%. There are funds that have done 60, 62% sort of return that has just come in 1 year, right? That is your absolute return that has come in 1 year. There has been madness in the market. There has been so much optimism in the market. So you look at the cycle. There's so much optimism in the entire market where you saw growth coming in and growth being rewarded very, very highly, right? So public sector funds have done extremely well in the entire of last year. But if you look at it from a longer term perspective, this is the chart that's extremely important, right? If you look at it from 2000 to 2010, your public sector index did extremely well, right? you saw them do extremely well at that point, outperforming even Nifty 50. But what happened during after global financial crisis all the way up until 2020 was that the private, that is just the pure Nifty 50 X of public sector enterprises, did started to do extremely well. And this is because naturally debt levels are very high. Commodity prices came off. You had a scenario where it was more consumption oriented growth that was not coming in from commodities. It was more credit driven. And naturally, you saw that things were taking place. On the flip side, on the opposite side, we did not have much growth coming in. Growth was only coming in from these areas. Right? Second, what happened was we had credit crises. We had IL&FS crisis. We had DHFL. We had Jet Airways going bust. So we had a lot of crises that came in where public sectors happen to be public sector banks per se happen to have a lot of exposure. Okay, so one way where your commodity prices are not doing well, the debt is extremely high because because to funnel all that particular growth, they've underwent capacity addition, and that was debt fueled capacity addition. Naturally, when global financial crisis happened, things went haywire. So your metals also, your entire commodity pack does not do well. That is your energy, your metal, everything does not do well. Things that were contributing very highly to profit pools for public sector did not started to come off. They were not doing extremely well, right? Uh, and then second, you had crisis after crisis after crisis, right? So your financial services side went down, and your commodity oriented side, that is core to economic growth, started to go down. Naturally, there is deep pessimism that comes in into such areas that go prolong all the way from 2017 to 2020. 3-4 years, you see deep pessimism starting to come in. You see 15, 16, 14, 15, 16 is when trouble starts to come in. You see that things are unfolding very slowly. Things are coming out in the light very slowly. But at that point, you also had the small and mid cap boom. So public has not participated much in this, right? Though they by virtue of flows into small and mid cap, whatever was small and mid cap actually did well, but fundamentally they were not doing very well. So they don't get that sort of valuation that comes into it, right? So you had periods of deep trouble where things have to change from an economic perspective, from a macro perspective, things have to change. And now you look at what has been happening. That's a one-way rocket ship up, right? But what happened? Inflation started to come in. Your commodity prices started to go up. By virtue of commodity prices going up, operating leverage kicked in. Whatever volume that was going out at higher prices. Whatever inventory was there was valued at higher prices. Naturally, things tried to hit the bottom line. When things tried to hit the bottom line, debts were being paid off. Natural re-rating that takes place. Second, your banks, right, that contribute suddenly now after 2022, was that 18, 19, and 20, they were being recapitalized, which means the government was supporting them. Right? They were giving them a sort of money to write off and make provisions for all the bad loans that they had done, right? That was taking place. So during COVID also, the entire public sector banking space did not go through big problem. The metal space, however, went through a lot of problem. That is, your entire energy pack went through a lot of problem. But by virtue of inflationary price increase, scenarios changed very fast, right? So you as an investor, what do you think? You cannot wait for some scenarios like this to happen. You have to commit your money to know that when something is cheap, and you have to start building positions then, right? So we were able to build that particular position in 2017 onwards, all the way up until all the way up until 2021, right? So 5 years, it was just a buying, sort of very patient testing phase, not only for us but for all the investors also. And these were not small positions; they were very large positions. So when you take a very large position call, you naturally go through that big bit of a problem, right? But the performance that has come in the last 2 years alone, right, last 3 years alone, has covered up for what it lost from 2015. So if you see from 2000, right, the public sector enterprise index CAGR is somewhere around 14%, where your Nifty is somewhere around 13.5, 13.7. Net, uh, yes, they have done much more better, but the performance comes in certain blocks. And this is true for all teams. This is true for all sectors, right? That's why I always like to show the quilt. that there are certain areas, there are certain segments that do very well for long periods of time, right? 10 years you see growth coming in, and then for the next 10 years you don't see any growth starting to come in. A lot of wrong things that were happening had started to unfold out, which created a lot of negative sentiment, which created a lot of pessimism. And by virtue of that pessimism, when there is sell, when there is fear, valuations come to you at very cheap prices. And that's when you have to take that conviction call to commit money. But for how long? So if you see by history, it has taken a long time, right? But when the reward does come in, it comes in a block, right? So it takes a long period of time for such things to take place. So it's not as easy as just seeing 2 years back and saying, yes, let's just do it. This gives you a total script of how things have taken place and what you should be seeing in terms of this entire narrative of public sector, right? Now, here, so you look at after a decade of underperformance, public sector index is seeing upward trend, but this is a very good thing, right? Where they've split. This is what I was talking to you about, where they split. PSU index generated 11 times return versus the Nifty 50 during that 2001 to 2010 decade, right? Where Nifty was only 5.77 times, right? Nifty was nothing. They did not perform that well. But in the subsequent years, that next decade, Nifty 50 generated more and you saw negative returns that came in the public sector index. So somebody starting to invest money in 2010, since we are all long-term investors and you need to consider it only from a 10-year sort of horizon. 10 years an investor has not made any money, right? But going by history, things have been so well. What do I do? You again start asking those questions of did I do the right thing? Did I do the wrong thing? You go through all these problems that come in. That's why you need to have a financial advisor. That's why you need to go to somebody who's some sort of an expert in these subjects alone, right? But for 10 years, you've not seen any money being made. And then you take that call. And I did this exercise once where we split up, and it was a very interesting exercise, right? By the end of that particular exercise, everybody went back, and I got feedback saying, I'm now confused as to what I need to be doing, right? I thought I had a particular process, but that's not the right process. And I have to go back to my drawing board to see what I need to do. Right? So in this particular decade that has is 4 years in now. This is as of 2022, so this number is much more higher, right? The PSU index started to outperform with a 60% return versus 25% in Nifty 50. Right? This is 2022. So you add another 1.5, 2 years. This number is extremely high, right? So with Nifty also hitting all-time highs, this has outperformed Nifty by a very margin, very high margin, right? And why has that actually happened? You're seeing a lot of support that is coming in from the government. So why is it that this is happening? Why is it that PSUs are the main focus now? Why is it that returns are sort of coming back in? Right? Why? Is it disinvestment? Is it that they were trading at favorable valuations? Is it that the government is increasing its spends? Is it that core economies are growing? That's why things are changing. Why do you think that this is happening? Yeah, I think C and D is good. I think all the options are somewhat valid, but right now in this cycle, what is playing out is C and D, right? Government has supported a lot. C and D is actually playing out very well. That's why you're seeing that PSUs are now a major focus, uh, uh, for the last 2, 3 years. So if you feel that I'm going a little fast, or if you want me to go slow on a particular slide, do put it in the comment box. And if you are uh, uh, tuning out also, do give me a shout out, and I'll try to change certain things here and there. Right? So there has been a very sharp uptick in capital spend that works extremely well in public sector's order books, right? Why is that? Is that always whenever there is some bit of increase in terms of capital spend, that's what we saw during 2000 to 2010. The first one would obviously be public sector because it takes time for private to start putting up that capacity after seeing that yes, things are doing very well. There is demand that's coming in to support that particular supply. It's all demand and supply, right? It's all capacity addition versus making sure that all that capacity is being met. Right? It's all demand and supply when it comes to public sector. It has nothing to do with just looking at demand. So when the demand is high, right, that this is what has been happening over the last 3-4 years, where the demand has been very high, right? So capital spending as a percentage of total spend for the government has been very high in the last 2-3 years, and they're continuing to be high, where the government wants to spend money a lot in this entire decade, right? So now that things are known, yeah, the government is going to spend money, right? Things have changed. You as an investor have to ask this question: what is it that the market is sort of factoring in right now in this price for public sector? Is there incremental growth that can come in? What should I see when it comes to looking at incremental? What should I see? Right. If I have to see that things are going extremely well, things are extremely bullish, are things already factored in? What do I need to see? Right. But one thing is that yes, capital spends have been supporting public sector, and this trend is here to stay. Right. Usually, what happens is if you look at 2001, 2003, 4, PSUs did very well. We had 7 PSUs that had gone through some sort of a disinvestment, right? And 17 to 22, we saw increased capital spending that came in. In 1 year alone, spends were very high. Naturally, that all it's like a rubber band, right? Things are extremely low, and then all of a sudden, because of negative sentiment, because that cycle has been completely against, because there's negative sentiment. It's been going on for years together, and suddenly when you see positivity coming in, everybody is rushing in to get that to get a piece of that action, right? And that's what has happened here. You're seeing this cycle is more related to increased capital spend, but not disinvestment. However, 17, 18, and 19, we did see some names where they were up for strategic sale, right? Strategic sale. Even in this cycle, we saw 1-2 names on the metal side going up for sale, and there were a couple of big names that bought into those core sectors of the economy. Right? So, is it the right time? Right? So, if you see this in 2022, right? So the share, sorry, in 2012, if you see the number of PSU stocks that were there in as per market cap was only 29. Now it's 13. As per PAT, it's 29. So net, more or less, we are here to stay. There are few PSUs which form a part of these top companies as per profitability, but not as per market cap. Now it has come in as per market cap. So the share of PSUs in the top 100 companies as per PAT, right? 34% is only on the PSU side and 65% is on the non-PSU side. This 34 has actually done that thing for you, and they happen to be only 8% or 9% of the entire market cap of the top 100. Right? That's why you're seeing a lot of performance coming in. This is just crowding. It's nothing. Fundamentals have changed, but weak sentiments have reversed, and there is crowding in that has happened in this entire space. So investors who weathered through all that in the last 8 years or so are benefiting now. But can you benefit from here on? Right. If you see again, profit PSU's contribution to the total corporate pool is now only increasing. Right? We went from they were very high all the way up until 45% to now 14%. So don't expect that suddenly it will go back to 45%. That's not the right way for you to look at things because competitive intensities have changed, the dynamic has changed, economic environments have changed. So naturally, because it is here, you have to ask that question that yes, things are going to change, right? And things have started to change already, and the valuations are already being factored in for this particular change. So there's not a lot of scope for you to actually make that incremental big that came in the last 3-4 years. Right. So PSUs as a percentage of market cap also has, by virtue of their performance going down, negative sentiment has been going down, but this number is slightly starting to go up. Right. Now, this is one thing that you need to see whenever it comes to cyclical investments. Always look at ROE. Don't look at PE. Don't look at PB. Don't look at all of that, because PE will look like, because the earnings are depressed and the PE will look high. But suddenly when the earnings come in, which means that the cycle is playing out, right? Which means that the cycle is playing out, which means that the earnings are coming in. Naturally, it takes time for investors to uh, sort of reverse that particular sentiment, market to reverse that particular sentiment. For you, that PE will look very low. It look like it's 3, 4, 5, 6, something like that. But the earnings have started to come in. So you need to look at when the earnings is coming in, why the earnings is not come in. And one way for you to only look at that is to look at ROEs. So PSU ROEs have dropped significantly. So you look at 16, 17, 18, and 19, PS ROEs are extremely low. This is the cycle. This is your long-term cycle playing out. This is the first slide. This is the first slide, right? So it has taken how many years? It has taken almost 6, 7 years for things to play out, and now your ROEs are back, right? Which means that whatever growth that had to come in sentiment, in valuation, everything that had to come in has already come in. So from here on, whatever is there is extra. That's what I would tell you. Growth is definitely there. These are segments that will start getting better, start getting stronger. But what had to happen has already happened. So you can't bet on this fact starting to take place. So now what is that particular expectation that is there amongst investors, right? So I think this happens to be my last slide. So we have a good amount of time for discussion on public sector, and you can ask me whatever question you want. Don't ask me stock specific questions, please. But anything to do with how we have been playing this entire slide, what we are doing now about it, that very, very happy. But if you only look at it from a ROE perspective, which is what you always need to look at, uh, financial ROEs are looking extremely strong. The ROE is also looking very strong. Valuations, if you after this, if you see PB and P, they all look very fair. It's not that it is extremely cheap, but it is somewhere on the fair side, right? But your ROEs are expected to remain on the higher side, and not as high as what it was 2 years back, because the earnings came in and things were looking good. But from a sustainable perspective, until things go very bad, until things go haywire, if things go as it is right now, you will just have good amount of growth that comes in this entire space. But valuations do not support it right now, which means that your earnings have to continuously keep growing for you to support that particular sort of valuation. Right? That happens, then it's extremely good. If that doesn't happen because of any macro factor that comes in, where you have to now know that, no, given the current macro scenario, because they are sensitive to sort of government spending, they are sensitive to whatever macro scenario comes in, that the risks are high right now. So that's the call that you have to take right now. Yes, the risks are somewhat on the higher side. That doesn't mean that you shouldn't commit, but right now, not very healthy to see that the risks are playing out more on the higher side than on the lower side. Right? So as things stand, things look okay. Things do not look like there is a very, very high sort of growth, but given that the risks are increasing, valuations look to be on the higher side. Right. So now I will open that particular flow for question answer, and I've put in the number here. So if you do have any sort of question, if you do have any sort of query, if you do want to do anything, just send a hi to this particular number, and given whatever your requirement is, and then we'll see what we can do best for you. Right? But Milestones to Wealth is not meant to pitch a particular idea, is not meant to pitch a particular saying you need to do this, you buy this, sell this. But this is more from a behavior oriented. This is more for you to understand how things are playing out, how things have been playing out, how things are playing out now. This entire platform is to make sure that you have this habit of saving, right? Have this habit of continuously keep on saving into the market, where you can make more than FD, where you can beat inflation, where you can consistently grow, somewhere around 9 to 12%. And if things go extremely well for you, where we are positioning you extremely well, somewhere around 12 to 15%, where you can compound money stably, right? And meet all your goals. Our entire endeavor is to make sure that you reach to a particular target that you yourself are setting. And that's why we have milestones and everything is a basket, and everything works on that one particular milestone that you set for yourself, right? So now I'll open the floor for Q&A. You can type in whatever question you want regarding equity, regarding PSU, any other theme that you want. I'm going to be doing a debt presentation again about long duration. So don't ask me anything about debt right now, but you can ask me anything about precious metals as well. So we have done precious metals webinars. We have done it multiple times. So you can ask me anything about those particular things. Nothing stock specific, please. So there is no PSU index fund. There is only a PSU bank index fund. And uh, so our PMS, that is the multi-asset PMS, since it is a thematic fund, I just came from that webinar where we had taken a call on public sector bank, and it was a very high call. It was a very high conviction call that played out very well. So there is no PSU index fund. There is a CPSE fund that is again playing out very strongly. And there is a public sector bank fund. Right now is not conducive enough for you to start building positions now, because like I said, the macro risks are very high outside, not in India, but very high outside. So if you can commit to more than 6 years or 7 years of money, that depends on your goal, that depends on your risk profile. But right now, as a template, not a good time. Of course, it is great to look at these stories and the narratives that has been coming out, but things have already started to play out. That's why I showed you the ROE slide. That things have started to already play out across industries in public sector, because the focus has been there, right? So they have done a big jump up, hoping that things would go from expensive to fair or fair to cheap. That's not a good expectation for you to have. Sometimes expensive stays expensive for a long time also. So you can't do anything about it. So what you need to see as an entry point or something like that is when earnings growth continues to remain high, continues to remain strong, that there's no slowdown. How will the growth for public sector banks be over the next 5 years? Banking as an entire sector itself is poised for growth. We are having very strong credit growth. Deposit growth is yet to show as a strong sign, but entire banking space is poised to do very well. I had covered banking in the strategy series for what to do in 2024. What is your expectation? Themes that you should be looking for in 2024. So you can just go to our Milestones2Wealth YouTube page, and you can go on to live, and then you'll see a lot of webinars. And then one webinar will be strategy series, what to do in 2024. I think that's the title. If it's not, it will be the right asset allocation in 2024, and you will get that. PSU active fund, there are about 4 active funds right now. I think 5 now. Quant has come up with an NFO. So you're seeing, right? I can give you one example. Uh, there were only 2 funds in the entire space in 17 and 18 for public sector investing. Then in 2020 came one more. Then in 2022 came one more. And now in 2024 is another, right? So it's like how you see momentum as a strategy. You're seeing a lot of NFOs on the momentum side. You're seeing a lot of NFOs that came in on the flexicap side during one point, right? So wherever there's optimism, wherever there's bullishness, usually there is wherever there's high demand that starts to come in, then you start supply. It's supply demand. So by virtue of that, you're seeing already, a lot of uh, bullishness that's coming in, and that's why you're seeing funds also coming in. Everybody is starting to come into this space, right? And these are the same same segment of the market that was against public sector. That was very negative about public sector. So when a negative person becomes positive, then you know that okay, things are looking very, very high. There's a high optimism level that is coming. So you have to be cautious on that. Can we exit PSUs completely? So it depends on your risk profile. It depends on your goal. So what you can do is just send us a hi, or ping us, or get in touch with your point of contact. I don't know if you're there on the program. If you're there on the program, very good. Just reach out to your point of contact and we'll be able to help you out. But it depends on your risk profile. It depends on your particular goal. What is the forecast for PSU funds for the next 5 years in terms of growth and risk in parallel? Good question, and I'll frame it very different now. Where do you see any downside risk right now in public sector for the next 5 years? So the downside risk right now only comes in from macro. That's it. That's the only risk that's coming. If you're very bullish on the world, that yes, everything will do well in the world, there will not be any problem that we face in US, in Europe, in non geopolitics, then the downside is low. However, if you have a flip view, then your downside is high. Right now, private banks comparatively cheap and growth prediction also more on uh, compared to PSU Bank. What's your view? Uh, if you're getting very large names that are cheap, then you know what to do. I mean, uh, more than this, I cannot tell you. Right? So if you're already on the program, then you know already what we are trying to do for investors on the program. So that's why if you're not on the program, get on the program and you'll know how we are trying to play the entire banking space. There's a question on market and PSU sector high. Yes, earnings growth is very strong. So don't look at it from a market is high, I should not invest. No, earnings growth has been extremely strong. Corporate profit growth, earnings growth has been extremely strong. They're pushed to be very strong. Right? Things have been changing. So the best way for you to do any sort of investing in the market is SIP. The best way for you to do is SIP. Then take a call for uh, lump sum investments. Lump sum investments only in certain parts of the market where it is considerably very cheap. So SIP is the best way for you as an investor to go. Second, what you should see is that don't expect corrections to come in. Why you should not expect corrections to come in is because domestic flows have been very strong. You, me, everybody here is doing SIPs and our SIPs are going up. So SIP number is going up. Naturally, flows have been very, very strong. Domestic institutional investors, that is the mutual fund, by virtue of us pumping in money, they have been supporting whatever small corrections have been coming in. So don't expect deep corrections like what came in 2022, 2021. Wherever there is, some bit of correction that is coming in, domestic institutional investors are going and buying that out. So SIP is the best way for you to build wealth in India. Right now, SIP is the best way. Make sure that every year you're able to step up that particular SIP that you're doing. SIP is the best. Don't look at it from a market high perspective. SIP is the best way for you to go and do it. I'm in M2W SIP for the last 1.5 years. Can I visit your office? Sure. Please do get in touch with your point of contact and you can drop in whenever you want. No problem at all. In fact, when you do come in, you will be able to see the scale of operation that we are running at, and that will give you more confidence of uh, how we are trying to look at Milestones Wealth, how we are wanting to help aspirational India. PSU sector cyclical, yes, definitely it's cyclical. They are economically sensitive. Uh, so whatever happens uh, on the macro front uh, affects the public sector. In fact, most sectors. So this is one that is more government oriented. This is one where they happen to be in important parts of our economy. They operate there. So naturally, they are more sensitive. They are more cyclical to uh, whatever happens on the macro front. Is it the right time to invest in public sectors? You're getting, if you compare the opportunity that's there everywhere else, and valuations are conducive enough, then that is a better opportunity for you to look at. Don't chase returns. We had a very good presentation before I came into this one, where we were flipping risk to rewards, and there was a very good slide. Maybe next time I can put that slide also of what happens when you keep chasing returns. So don't chase the return. So financial advisory is not something that, uh, so it was a service that we were running, but we don't do that anymore. We have a financial planning service where the cost depends on the scope of work, and we also have a PMS service, right? So this is so advisory was there before. Now that business is no longer there. But apart from specific accredited investors, but right now there is no advisory. There's a planning service, and there is a PMS service, and there's a distribution service. There is a mutual fund distribution service. So definitely you can set up with whatever requirement you have. Definitely we will be able to help you out. So do just send us a hi here, and somebody from the team will get in touch with you. If you can just send us a message on this number, or reach out to us by mail, we will definitely be able to set up a meeting with you. Again, this question is on stock specific, so I won't be able to answer stock specific questions. So I'll keep the floor open for another 2-3 minutes, and do put in whatever question you want. Second, do give me a feedback. If you think that this is helpful to you, this is not helpful to you, do give me a feedback. And if you want any particular topic that you want something to get covered, I'm very happy to address that. So do put that also in the chat box. And again, get in touch with us. We are doing a lot of work when it comes to helping investors, handhold investors, to help them reach a particular milestone by themselves. This has nothing to do with, it has everything to do with behavior, right? So Milestones to Wealth will help you out in terms of behavior, of creating that habit to save, and that sets the base for you for everything else and all your goals to come. You have a car goal, yes, you can meet that. You have house, you have travel, everything else can come into this place. So do give us that particular feedback, and I'm interacting with you every weekend. There are insurance teams that is also interacting with you. This is on a weekly basis again. If you do want particular topics to get addressed, if you do want me, if you do want to give some feedback, please do put that also in the chat box. Any books? Think I don't have that book right now with me, but Pat Dorsey is one book, little book that builds wealth, that helps you build wealth. Is a very good book. Masterclass with Super Investor is very good. See, these are all uh, Richer, Wiser, Happier is a very good book. This just gives you a perspective. But the entire thing boils down to behavior. This has nothing to do with fundamental investing. This has nothing to do with any of that. Everything has to do with your behavior, and you should read books only that is more behavior oriented. Uh, I think Morgan Housel does Psychology of Money, which is again okay. I mean, it's a good book. You should definitely be able to read that. And Same as Ever is also one book that I have here. So that again is a good starting point for you as investors to sort of read into. But always choose books that are more behavior oriented. Don't try to do valuation and fundamental oriented stuff. You just need to have a basic understanding of all those things. But behavior is the one that is going to set you apart from all the other investors, and that matters more than anything else. So behavior matters more, because even if it is a cheap valuation, say for example, but your behavior is not right, you're not able to capitalize on it, then you will not be able to capitalize and you will not make incremental high returns. So behavior is everything. So read books that are only behavior oriented. How to check valuation in stocks? I think Sham sir has already spoken multiple times about it. So I will not do that webinar, but Sham sir has already spoken about it multiple times. There's this obsession with stocks, which I think that mutual funds are the best way for investors to save money. There's a lot of data that's coming in from the mutual fund side alone. So go where there is data, then you know that things are very serious. Where there's no data, then things are not serious. It takes a lot of time. There is to scout through that data. When things are happening, things are going according well, then stick to that. Stick to that. I'm very glad to hear that all our webinars are very helpful, and it gives you this conviction to continue your SIP. Just keep continuing your SIP. Don't stop your SIP. SIPs are not meant to be stopped. This is where if you do go out and start stopping your SIPs is where you're creating a very bad habit. Right? It's You have to continuously keep saving. You will average out, and you're a long-term investor. You're not a 1 year or 2 year sort of investor. You are a long-term investor. You are a 10+ year uh, investor. What do you think of active and passive based investing, especially in the PSU space? Very good question. Uh, See, when you're having that option, that I would always say take an active, right? Because it's very difficult for you to time passive. And right now in the passive space, for public sector, there is only two. There is CPSE, which is more to do with your power and energy names, and your bank is again pure bank, right? But when you look at an active fund, they have the option to take advantage of all the other sectors as well. There's defense that comes into place. Uh, there's financial services that comes into place. That's basically your insurance and your AMC names that come into all this. Right. So I would always suggest that you have passive as just something like a satellite. You don't need to have that also unless and until it's in a deep cycle down. Like that's where you can add to your conviction. But active space is always the best. For this particular thing, active works extremely well. You can't take a sectoral call like this on the passive side unless and until you have high conviction and it's in a deep cyclical low. So what we were able to do on public sector banks is exactly that. Right. But before that, we were able to take advantage only of the active funds. Though that option was there, but from a broad-based perspective, we were doing the active fund. And then to top it up like a basket, right? Where you have to be overweight in that particular segment of the market. In PSUs, you want to be overweight only on that particular thing. Then you can choose within CPSC or public sector bank, right? But your base has to be somewhere be on the active side. Active side always you have wider options, and that works. Only a deep cyclical low, please go ahead and take that passive. Great. So I don't think that there is any further question. So thank you all for joining in. Have a great weekend ahead. Looking forward to seeing you in the next webinar. Thank you so much.